You're listening to the Multifamily Mentor Show.
My name is Terrence Doyle.
And I'm Chris Lopez. You probably know us from the BiggerPockets Real Estate Ride Along Show. Well, now we're talking everything multifamily. We bring in top industry experts from around the country to come join us in our Denver studio for an in-depth, in-person conversation.
We're going to be diving deep into deals, underwriting, raising capital, and everything in between. Join the conversation.
Welcome back to episode 2 with our guest from Boston, Massachusetts. We're going to talk about 3 creative ways to finance your multifamily. Terrence, I'm excited to do episode 2. We did episode 1 earlier today. What are we talking about today in detail?
Yeah, this is something that Axel has completely mastered. Of all the people that we've talked to throughout my years of doing multifamily and the show, I think you have nailed it better than anybody. So super excited to unpack some of the nuances on creative financing. So welcome back, Axel, from the Northeast, one of my favorite parts of the country, as we've discussed. Great beer, great people, great sports town. We could have another episode just on the Northeast, but
I'd love to come back for it.
We'll digress to multifamily. So creative financing is the topic, and you have 3 keys to structuring creative financing deals. So unpack them for us. Let's go through one by one, and we'll go through some examples, some of the things you've learned, and how people listening and watching can apply some of the things that you've learned.
Absolutely, yeah. So like you mentioned, there's 3 main strategies that I've used in order to accelerate, growing the portfolio. And I know we're going to touch on all 3, but I want to start with the first one, which is incorporating some kind of investor buyout option in your LLCs if you're raising capital from equity investors. So obviously you can go the debt route and you can, leverage your properties, and that reduces your cash out of pocket. However, if you're raising capital from investors on the equity side, it's nice to have some optionality in terms of how they're being compensated. And if it's a deal that you would ultimately like to own yourself, working in some provision or some kind of option to actually get them out. So something that we've done in the past is we set a predetermined rate of return. We actually include it in the LLC operating agreement. So if we're raising capital from investors and we're also co-investing, but it's a deal that we'd like to get the investors out of so that we can, take full control of it. What we'll do is we'll write a provision in the operating agreement. We'll consult with the investors. We set expectations up front, and at some predetermined rate of return, we have the option to buy them out. And usually we tie it to a time frame of a couple years or something like that, so that it's not indefinite. It's tied to, hey, if we can deliver you 25% average annual return within 2 years, then we have the option. It's not forced, but we have the option to buy you out. And then we basically take ownership of your shares, and now we actually own the property or the portfolio or whatever it is. So that's something that we found to be really helpful in terms of, this is a deal that we want to do, but maybe we can't bring all the capital to close it. And it allows us to essentially get into more deals or to minimize our cash out of pocket while still giving us the option to own the whole thing in the long term.
So I love that. I've never done it, but I want to start to try and do it because there's been some killer deals that I've done in Denver, right? And I think the key to this is in markets that there's great appreciation, right? So rents are going up, property values are going up, debt is going down, cap rates are compressing, so getting more aggressive, so people are paying more per door every year. And you find this really, really attractive property, you're buying it right, and you don't have all the capital, so then you have to put together a syndication, right? So typical syndications, it's like a 70-30 split over an 8% pref, and those investors get 70% of the upside for the life of the deal on top of their 8% pref, right? And so in a market like we're in today, rapidly appreciating, right? Just like the Northeast, Denver's done that. There's some deals where you're like, man, I want to own the 70. I want to own 100% of this, right? So this is what we're talking about, that kind of deal, where you're like, this deal is going to appreciate really quickly. It's in a great part of town that I want to own long-term. How do I structure this, right? So this is the solution for that scenario, right? Exactly. So give us some real life examples of maybe the purchase price, how much money was raised, and what were the terms? Was it 25%? So if you're raising $100,000 per investor, so $1 million, let's say 10 of them, and it's 25% rate of return annualized, and it's 2 years. So at the 24-month mark, you returned to each investor $150,000, so 25% per year on each 100. So is that right?
Exactly, yeah. So basically, and it all depends. I mean, we've done it with different rates of return, different time frames. It all depends on the investor, really. I mean, fundamentally, you have to deliver something that the investor's okay with.
Right.
So, for example, one of the deals we did, and this is actually a legitimate scenario. We did this. We had an investor come in for $100,000 on a portfolio we bought up in New Hampshire. I think we did this one early last year, so it was a while ago. And a lot of the deals we do, we typically, refinance right at the 12-month mark. We finish our value add 9, 10, 11 months in. Right when it's a year and we've seasoned it, we can go out there and get really good debt. That's when we go and refinance. And basically, if we're able to deliver that annualized return that we set, and this specific deal, it was 20%. So if we can, we're typically paying along the way as well with some kind of preferred return, and that's also included. We can get into that if we want. But if we're able to deliver, $120K back in that year time frame to that investor, or let's say 140 and change in 2 years, then basically those shares in the LLC, we drop a quick amendment, they revert over to, either whoever the shareholder is, whether it's us or the LLC or what have you.
Right, the manager. Yeah.
Yeah, and then we own that. So in this situation, this investor was coming from the private lending background. So he's used to having his money in and out of projects relatively quickly. So investing his equity was like a little bit, of a different type of investment form. And he didn't really like the idea of having his money tied up for a long period of time, 5 to 7 years, like what we typically see in a syndication, or at least that's what's projected on the front end.
So he wanted to see velocity of the capital.
He's used to, I lend my money, 1 year term, I get 12%, and that's how I get paid. So I said, hey, if you want to actually invest in equity, your preferred equity, we're going to pay you before we get paid as the sponsors or the owners. We can set a predetermined rate of return and get you out. That's above what you'd earn if you were to lend it, but it's still something that gets you in the project, gets you excited. You can, see if you like investing in equity. It's a great way to convert hard money lenders or private money lenders you have in your network to equity investors. So at that year mark, we wrote them a check for $120K when we refinanced. Out of the refinance proceeds, drew up a quick one-page amendment. It doesn't have to be expensive. It can be pretty simple, especially in these smaller, joint venture deals.
Right.
I haven't done this on a formal SEC, 506, whatever syndication.
Right.
So I'm not sure, that might be a bit of a different proposition. But if you're doing a joint venture, it's a simple amendment. And he was out of the deal. We took his shares, and we did that with a few other investors in that specific deal as well, who were all on board with that strategy. He's happy. He made 20% in a year. He was also treated preferentially to us as the owner. So it was very similar to a second position mortgage or debt in some way, because he knew he was getting paid first.
Right.
And it was a win-win for everyone. And now that's a deal that we own outright. We don't have to service investors. We don't have to, we don't have to call anyone when we're making decisions or send out monthly updates or anything like that. I can do whatever I want with the buildings. I can sell them. I can, move cash from those accounts and other accounts. And it's just, I think that's the goal for me in real estate, is owning deals that I'm the decision maker and I have all the equity. And then, that's the goal is for deals like that. I want to build my own passive income. And if I can deliver a great return for investors that makes them happy, but also, achieve all the upside, it's a perfect scenario.
So at this 2-year mark, I'm a little hazy on the buyout. So if I invest $100,000 and I get, 20% and 20%, you're giving me that 20% returns plus my original capital back, or are you doing like a valuation appraisal on the property? I'm getting more upside down. They're like, what's the actual buyout mechanism?
So it's just based on your original invested capital.
Okay.
So whatever your initial investment is, we calculate a rate of return over a period of time on that original investment, and then that's what we use to buy you out, because that's how we're determining your rate of return is, what did you put in initially, right? There's probably a number of ways you can go with this, right? Where maybe you give them, a slice of the upside to some extent, and if you get over a certain rate of return, then the rate of return changes or the splits change or something like that. We've kept it very simple. I think oftentimes when you're speaking with investors that are coming from the debt side, or they're not necessarily really sophisticated in like private equity real estate, if they don't understand it, they're just going to say no out of, it's just going to be their reaction to hearing something, right? So I always like keeping it really simple.
Keep it simple.
Exactly.
Right?
I've always thought a confused mind just says no, right? So if you have to try really hard to explain all the nuances of this to them, personally, that investor might not be a good fit, or, maybe they really want to do something with you and you can get them there. But in general, I think if you keep it really simple and say, if you invest this and I can get you back this, which is going to be this rate of return in this amount of time, then we have the option to buy you out of the deal. And I think it's worth mentioning too that some investors don't want that. They want to take the ride with you. They want the upside. They'd rather not have that in an agreement, right? and those investors might not be a good fit, but I think the ones that are typically folks that are coming from the lending side, right? Because it's very easy for them to conceptually understand.
Yeah, so pro tip here, you just nailed on it. I want to emphasize it is, you got to know who you're talking to, right? So if you're talking to someone sophisticated from more of a private equity background, they're going to want the upside. They're going to want to take the risk long term. So the people to target for strategy number one, which is building an investor buyout into the entity, is going to be someone from a lending background, because they're used to seeing something tied to a finite period of time and knowing, even if it's less upside, they're knowing they can quantify exactly what that's going to be. They can say, hey, I can budget 20% a year on this bucket of capital because here's the agreement I have. And there's some people, just the way we're all made, they would prefer that to know exactly what they're going to make in what time frame versus having more upside. So those are the people to target, right? So you have to know who you're talking to and be able to qualify each investor. And so the right investor for strategy one is going to be someone that's more of a lender, private money lender, hard money lender that understands how lending works.
Exactly. And for the really sophisticated folks, it's basically preferred equity with a buyout option, right? Like, we're paying these people a 12% preferred return, similar to what they'd earn on hard money, but they're going to stay in the deal and they have the option to get bought out at this predetermined price. So for us, we could keep them in at that 12% and just keep paying them over time and servicing them as an investor. And, you know, there's probably a little bit more long-term, maybe financial upside in doing something like that. But for us, peace of mind, at least for me, is I like the idea of I just own the property, right? And then I can take distributions when I want. I can move, you know, the capital around from property to property, LLC to LLC, the way I want to do it, right? You know, I'm not tied to having to service the investors that are in the operating agreement. So I think a lot of this is, what's your goal, right? If your goal is, I want just complete control of real estate, I think it's a great way to get there with a little bit. You know, you just have to get creative, but it's a little less cash out of pocket.
I love it. I mean, the whole goal of the show and why Chris and I wanted to do this was, we want to be able to show people and talk about how to build wealth through multifamily, right? That's how I've been able to build wealth. Chris is building wealth that way. And that's what we're passionate about. And so the thing I love about all creative financing, and what we're going to discuss the last two bullets are, this is a way to accelerate wealth creation, right? If you are in the deal with your investors, you're still going to build your wealth, but it's going to be significantly less than when you own 100% of the deal. And so building wealth is not about how much money is in your bank account. It's about how much an asset you have and cash flow, right? And so that is the way to build wealth, is if you can create a win-win with investors that buys them out and keeps you with the upside. You own this property as long as you want, and every year the asset's growing in value, you're paying down debt, you're building your net worth. Okay,
exactly.
So that's a great thing. I love it. I'm going to try, the goal for me in 2022 is I'm going to try and build an investor buyout and do a deal that I do. So you've really challenged me.
Cheers to that, guys. Cheers to good tip one.
Yep. Cheers.
That's coming from the value add dad. You're adding value to me. So that was very valuable.
I love it.
Okay, so number two, let's dive into number two, because I really love this one as well.
So number two is figuring out how to work second mortgages into your deals. And I think that there's a connotation that is associated with second mortgages. I think it was probably perpetuated in 2008 to 2011. You know, people going underwater in their properties, people, you know, just over leveraging. I think the term over leverage is obviously, there's a negative connotation to that as well. So, and that's oftentimes, you know, I guess tied to second mortgages. And I think something that investors should focus on, especially when they're doing off-market deals or deals where they can get a little bit more creative. Maybe there isn't a traditional lender in the first position where they're not going to be, you know, happy if there's a second mortgage involved. But let's say you have a private money lender, hard money lender, some kind of bridge lender, some kind of alternate lender, seller financing in the first position, and you can get creative in the second position. I think that it's worthwhile doing so. So we've done a number of deals where our purchase price is discounted to market value day one, right? So we're buying with immediate equity at the time of closing. And therefore, whatever our loan amount is, there's a certain percentage to cost that is, you know, 80% loan to cost, whatever the purchase price is. But in reality, that might be 65 or 70% to the current loan to value. So there's actually room there to leverage the property a little bit more. So something we've done is work with private lenders to come in and place small, you know, maybe it's 7.5%, 10%, 12.5% of the overall cost as a second mortgage. And what we pitch typically is, we'll pay you a decent rate of return for doing that. We understand that there's more risk in doing that comparatively to a first position mortgage. However, in the overall structure of the deal, it's actually still leveraged in a pretty reasonable way. So this doesn't, you know, this might not work if you're buying something right at market. You know, you might have a harder time getting this to work. But if you're buying something that's, let's, for example's sake, 500 grand, it's worth 600 right when you close, and you have a loan for 400. You probably have room to get a $50,000 second mortgage in there and still be at a safe loan to value. So, you know, I spoke in the last episode we did about actually paying for simple appraisals to show either using the appraisal from the first position mortgage or first position lender if you have to go through that process, or you can even pay for one and get one on your own, or some kind of, something that shows the value as is of the property, and say, hey, even if you did a 10% second mortgage on this, we're still only at 80% loan to value here. And that really allows you to bring less cash to closing and allows you to make your dollar stretch significantly farther. And, again, I think the goal here is we want to get our money in more deals. We want to retain our cash so that we have some in the, operating account for when things go wrong, and it allows you to just do more deals. So I think people should start using second mortgages a little bit more.
So I love that. Let's unpack a couple nuances, pro tips here. So pay attention. So the first one is you talked about a desktop appraisal and appraisal. So that sounds, to some people out there, that could sound like, hey, how do like banks order appraisals? How do I order appraisal? So walk us through when you're doing second positions and the lender says, hey, Axel, I'm a little concerned about the value, a loan to value, because you have a first position, like let's use your $600,000 loan. The property, you're buying it for 5, you claim it's worth 6. I'm lending, 50,000 above the 400, right?
Yep.
So on the $500,000 note, that's what, 90% or something like that?
Yeah, roughly.
Right? He's like, I don't want to be at 90, I want to be at 80. So how are you producing that appraisal or desktop appraisal?
So I think in every market, there's a number of brokerages, and Chris might even be able to speak to this too, that do BPOs, like broker price opinions, or BOVs, broker opinions of value. And a lot of hard money lenders or private money lenders actually pay brokerages to put together a 10, 15, 20 page report with comps. It's basically a really official CMA for a property. So, desktop appraisal and BPO sometimes might be interchangeable in terms of their scope of work, or you can go to different appraisal companies in your area and ask them if they do desktops, right? Can you do this either with a drive-by or just from afar, without having to get into the property? And what's that going to cost? Sometimes it's a couple $100. Some places might charge $500. Some places, might charge less, right? It all depends. But if you speak with enough of these of these brokerages or appraisal companies, you'll probably find a few that are economical and that'll give you something worthwhile that you can go show a lender. So, for example, we've done this in so many deals where we're getting some kind of 80% loan to value or 85% loan to value first position mortgage, or loan to cost, I should say, because it's based on purchase price. But we're buying with so much equity that we have room to leverage it more and still be safe, right? We could close it at, let's say $1 million, but we could turn around and list it for 1.2 the day that we close. So whatever that, let's say we have an 80% loan to purchase price at $800,000, that's basically an $800,000 loan on a $1.2 million property, fundamentally, right? And there's probably room to increase that loan amount without, stressing a lender out, right? So I think, and then oftentimes too, what we do is we offer that second position lender a higher than market interest rate. So maybe they get 11% when they do first position private money lending. We'll offer them 12.5 or 13% or whatever. And for us, paying, financing that rather than paying it out of pocket, it allows us to do so much more with our resources, and it's worth it in the grand scheme to do that. So I think that to specifically answer your question, if you want to go and find companies to do appraisals or BPOs, I would just call around, ask other lenders for referrals, call up some big brokerages in your area and say, hey, do you guys do BPOs? Do you guys do some kind of version of a desktop appraisal? And I think you'll find a number of companies that will do that.
Yeah, two sources of places that have done this for me in the past is if you call some of the top brokerages, so like a Marcus and Millichap, Cushman Wakefield, JLL, CBRE, and say, hey, what appraisers locally will do a desktop for me on a multifamily commercial property, or banks. Call a local bank, someone that knows the area, and say, hey, what appraisers will do a desktop for me on this property? I need something quick, fast, and affordable, and they will know. So the two people that I would have in your back pocket, a local bank and a local broker that is maybe a bigger shop that works with a bunch of different appraisers, because those are the people that work with appraisers day in and day out. They're going to be able to give you that. The second pro tip that I want to unpack that you do very well, and you've been able to do, I think, with mailers and some of your social media stuff, is you have to, in order to get a second position, the elephant in the room is you have to be able to buy a property below market value. This doesn't work if you don't have significant equity from where you're buying it at. And so that is it. And so this is one of the reasons why everyone loves doing off-market deals, is you can't be in a bidding war and have significant equity in today's market, right? So in Denver, where we're at, almost every property that gets listed has like a bidding war, and they do a final, call for offers, and that's great for the seller, not great for the buyer. And that buyer that's doing that call for offers that wins, that's the highest and best, he's never going to be able to go and get a second position because it'll never appraise for enough. It'll be over leveraged, right? So the way you've been able to do this is by building relationships with sellers over a long period of time, right? Dealing directly with them, or a broker, but doing it off market, and knowing your market. I think that's the other thing I like is you're buying in neighborhoods that you know, that you grew up in or very close to where you grew up in, and that's what's allowing you to buy them deep enough to where you can put that second position.
Exactly. None of this stuff matters if you don't have a good deal. You can't do any of the things we're talking about. I mean, you could do number one, right? You could incorporate an investor buyout option even if you're paying market, right? I mean, but a lot of the creative financing strategies really only come into play if there's meat on the bone and if you have a relationship with the seller, or if you don't have a relationship with the seller and there's a broker, if you have a good relationship with the broker who can go to bat for you with the seller, right? It can't be we're at a fully efficient market. We're in it, like you mentioned, we're in a bidding war. There's not a lot of optionality there because other people are competing with you that aren't trying to do this stuff, right? And they can just go in and close quick. They're paying cash, they're getting a mortgage, they're bringing the cash to closing. It's very simple for the seller to understand. And then, it's really hard to compete with that stuff. So I would say all of this stuff comes into play after you nail down finding good deals, right? And finding good deals is possible, right? You can find good deals today and then you can put this stuff to work.
100%. You have to be able to find great deals with equity significantly under market value. That's the punchline. And that's really what I think you've done an incredible job of being able to do at scale. Okay, let's get to number 3.
So number 3 is the seller credit, right? And I think we talked about this a little bit in the last episode we did, but seller credits, again, it's a tool that you can use to reduce how much cash you're bringing to closing, right? And I have a bit of an example here, and I'll kind of run through it, which also ties into number 2, using a second mortgage. But in our last show, we talked about this deal that I did. It was part of a 27-unit portfolio up in Manchester. This is something that I did about a year ago. And the deal itself was about $2.2 million, but I'll break it down into one of the properties because basically concepts are the same throughout. So one of these properties was a 7-unit multifamily. Purchase price on it that I agreed to with the seller was $585. I said, can we actually do $625 with a $40,000 seller credit? And he was saying, yeah, that's totally fine. I net the same. I don't care, whatever, do whatever you got to do to figure it out. And we had a good relationship, so we could do that. The benefit to doing that is that after we factor in all of the financing of that $625,000 and then remove the credit, we're actually bringing significantly less to closing than if we just paid $585 with no seller credit. So for example, if we pay $625 and we have a first position mortgage of $500,000, which is what I had on it, about 80% loan to cost, and that was a bridge lender. I also had a second mortgage on that for $62,500, about 10% from a private money lender who was willing to do a second position mortgage. Basically, at that point, I have to bring $62,500, about 10% down. Now, with that $40,000 seller credit, I'm only bringing $22,500 to that deal, right? And alternatively, if we look at just a normal situation or even a situation without a seller credit and a second mortgage, right? So if we were just doing 80% loan to value on something like that at $585, that's a mortgage of $468, and then I'm bringing I'm bringing $117 to that deal. I mean, that's a huge difference, right? If we don't do the seller credit and second mortgage component.
So the difference was $22,500 versus $175?
$117 difference, yeah.
It's about $100,000.
Exactly.
That's a lot of money.
And even if I, work that seller credit in and still pay that work that second mortgage in and pay that $585, I'm still bringing, $58,500 to the deal in that scenario. Versus if I raise the price with a seller credit, it's all the way down to $22,500. So basically, what it does is it allows you to finance the additional incremental increase in price, and it allows you to reduce the cash that you're bringing out of pocket. So if you have minimal resources, right, like I did at the time when I was doing this deal, it's a $2.2 million deal. If I were to put just very simple 20% down, I mean, I'm going to have to bring 400 and change to that deal, right? That's a lot of money, and I either have to go and partner with another investor, I got to go raise equity and give up some of the upside, or I can do some of these things where I finance that 10%, I work a seller credit into the overall deal. And I was doing, 40, 50K a property, about 200 grand for the deal overall in terms of the aggregate credit. By the time I'm done, I'm only bringing 100K to that deal, right? So it greatly reduces the amount of money that you have to bring out of pocket to actually close it.
So that's a really powerful tool, right? Seller credit. We talked about in episode 1, I just want to reemphasize it, is you have to have full transparency in this. You have to communicate and be very clear with the seller, like you said you did, was, hey, let's increase the purchase price. Oh, Axel, why do you want to do that? Well, I want to be able to increase the purchase price so that I can bring less cash so I can do more deals with you. Okay, great, Axel, let's do it. And then you explain that to the lender. Hey, I'm gonna get a first and a second. I'm gonna do the seller credit so I can bring less cash, right? So you gotta be able to communicate that, be very clear and transparent about with both of those parties. And then that's a killer deal. I wanna be able to emphasize that the difference is roughly $100,000, right? So you could do 4 more deals, right, by doing this seller credit. So you, instead of bringing 117,000, you only had to bring 22, and to buy a $2.2 million portfolio, you put in roughly $100,000 versus putting in 400,000.
Exactly.
So 3 or 4x. So you can do now, you could do that same $2.2 million deal 3 more times with your 400 grand, right? And so what does that do? That accelerates the ability to build wealth, right? Is you're able to do 4 deals in the span of a year versus doing 1 deal, right? And so that quadruples your cash flow and your net worth and allows you to build wealth a little bit faster. Now, the key to all this is you have to know the market, you have to know your business, you have to understand construction, property management, which Axel does. So I'm not endorsing going out and doing this for your first deal, but once you get into the rhythm, this is for people that are in multifamily currently, that want to grow their portfolio and want to figure out, hey, I'm cash strapped. I don't really want to bring on other partners. I want to take the risk of, having other GPs or LPs and having to do investor quarterly reports, which I know from experience is exhausting, right? I mean, we have a whole team, all they do is crank out reports. They're beautiful reports, but it's exhausting. And so maybe you don't want to do that. This is the way to get around that is, hey, I have a pile of cash, maybe it's 100, maybe it's 200, maybe it's 500,000. And this is the way to take that $500,000 and expedite the wealth creation and having your money go longer, right? And so creative financing, to me, it allows you to do 3 things that we've been talking about is close deals faster, right? So traditional banks right now with appraisals and environmental and third-party reports are like in Denver and Des Moines, 60 to 75 days. Yeah. I don't know what it's like.
No, it's the exact same, and we're in a competitive market. If you can tighten up that timeline, you're going to be in a much more competitive position.
Way more competitive, especially when you're dealing with mom and pop sellers that are not wanting to list with brokerages. What they're looking for is convenience and speed, right? And so when you can bring up these creative financing tips and what we've been discussing here, you're going to have a much better chance of getting the property you want at the price you need it at. So the number one is it allows you to close much faster. The second one is you can do deals without having to have multiple partners, right? I mean, I just did a deal and we had 15 LPs, right? And so with what Axel laid out today, you're able to do more deals with less number of people, and it really just simplifies your life. It allows you to have less overhead because you don't have to have a staff to do all the things that's required when you have investors. And more importantly, I think, is it allows you to build wealth faster, right? Because you're going to own more of the upside. And then the third one is you can keep the upside of your deals. I just think, we're in an inflationary environment where rents are going up, debt is pretty cheap, all-time lows, right? And cap rates are compressing, which means the valuations are getting more and more aggressive every year. And so that means that upside is worth a ton of money. And so if you're able to buy out your investors at a certain predetermined price, if you're able to use second position lending, and if you're able to use seller credit, like we've been discussing, you're going to be able to get into some really attractive deals and build wealth for yourself. You're taking all the risk, you're putting these deals together. It's super hard to put these deals together. And so I'm a big fan of owning the upside. And I love, like when we first talked on the phone, I was like, this guy's nailed it. You know what I mean? Like you understand this possibly better than almost anybody I've talked to. And this is something that. I hope that people are really listening to and press pause, slow it down, look at the numbers that we're going to put on the screen, because this is like super, super valuable stuff here if you apply it.
Yeah. And I think we're in a position right now in the market where good deals are not easy to find, right? You can find them, but it takes a lot of work, and it's, there's, whether it's off market, whether you're working with a broker, no matter what you're doing, good deals are not easy to come by, right? So when you do find a good deal, especially if it's off market, and you can build a relationship with the seller, and you can get creative with some of this stuff, you owe it to yourself to do that, right? Because it's one of those things where you don't want to just take a good deal for granted. You want to make sure you maximize every single component of it to the highest level you can, right? Whether that's putting less money down or, creatively structuring it or actually operating it really well and getting the most on the back end. But it's really hard to find deals, right? And this can help you maybe turn some deals that otherwise would be mediocre into really good ones, but it can help you get the absolute most out of the really good ones that you do find.
Something else you're great at is like building a personal brand, pushing out content, which definitely helps out with all of this. But can you talk briefly on how building a personal brand between your social posts on Instagram, LinkedIn, your podcast, how that helps facilitate you finding deals with sellers and also brings legitimacy to your lenders and partners as well.
Absolutely. So I think one of the best things I've done and focused on in the last year and a half or so is being like mindful about building the personal brand, right? And I mean, you guys are great at it too. It's one of those things where it makes everything else in your business much easier. It makes recruiting easier, raising capital easier, finding deals easier, all of those things. So for me, a couple of the direct applications of it, I'm really active on Instagram. That's the medium that I choose to be active on. It really helps me find, not necessarily like sellers that are bringing me deals, but it helps me find deal finders, right? I can network with brokers and wholesalers, other service providers that might be in the mix. Like I can get in touch with more of these people in a more scalable way. And I'm always putting up on Instagram like, hey, I'm looking to buy 10 to 80 unit properties in Central Florida, Lakeland, right? We did a lot of business in Lakeland this year. I partnered with a couple of guys that are in Tampa that I met through Instagram that we found deals, and we did 2 deals, 44 units in Lakeland this year, right? Pretty much all through Instagram. And then finding, I guess raising capital specifically, not only can you find investors, people that kind of follow along, they see what you're doing, they're like, this is really cool. I want to, hop in his car here and go for the ride. But also, if I'm networking with investors outside of that, and then they're looking up my name or looking up my business, they see like a platform online, right? Like there's a lot of validity to what he's doing. This isn't a fly-by-night guy that is just someone that, doesn't have a platform or doesn't have something to lose if things go wrong. And it makes the investing decision a lot easier for folks, right? I'll tell a quick story. I'll be brief because I think it really illustrates this. So I live in South Boston. I was at a bar in South Boston about a year ago, and I left late at night. It was like 1 a.m. or something like that. And me and a buddy were riding those, city bikes or blue bikes home, and my wallet falls out of my pocket. And I don't notice till I get home. I wake up the next morning. I'm like, I lost my wallet. So I'm canceling all my cards and all that stuff. And I get a DM on my business Instagram from just a guy who found my wallet and who lives in South Boston. And he's like, hey man, swing by. I got your wallet, all this stuff. I'm thanking him, all this. So I go to meet him, and he gives it to me, and we just start shooting the stuff. And he's like, hey man, I was like scrolling through your whole Instagram, and like I love what you're doing. Like that's so interesting. Like I've been trying to invest in real estate, all this stuff. And turns out he's a really smart, friendly guy, works at Amazon, makes great money. And he's thinking, hey, I would love to get into some of your projects here, in whatever capacity makes sense to do that. So fast forward 6 months later, he's investing in our deals, right? And it sounds like the craziest thing. He finds a wallet on a road and then he ends up working with the guy. And I joke with him about this all the time. And but that's the power of it, right? He goes and sees the platform. He sees that I got a podcast. He sees the Instagram, and he's like, all right, this is like cool. There's something here. And obviously that's an extreme scenario, but even just the fact of somebody Googles your name, if they see that you're really active in the business, people want to work with folks that know what they're doing, that are A players, and that if things go wrong, they're materially impacted, right? So you never want to work with a contractor that just doesn't have a business card or a sign on his truck or any of that stuff, right? It's the same thing with real estate or partnering with folks or investing with someone. It's the same concept, right? So I think that's been a great use of the social media, a great byproduct of focusing on that, I would say.
I love it, and that's a great story. That man, it just hammers home the point because. Yeah. It shows how the personal brand works. And I mean, we've all been there before. Like you go out there and you Google someone and you see a company, a great website or a poor website or no brand. Like it makes a difference on your impression. Mm-hmm. Like we all know we shouldn't judge a book by its cover, but we do. Like it's first impressions. If I Google your name and great stuff pops up, I Google your name and nothing pops up, I'm more inclined to keep looking at his stuff.
Totally.
Mm-hmm. Exactly. And just sharing what you're doing brings people into your circle. And that's, I think, the most important thing is you don't have to have a ton of followers, even if you're just, if you're going to check on a renovation, just take a picture of it, throw it up on your story, saying, oh, hey, we're bringing the rents from this to this. And then, might have a family member that's like, oh, that's really cool, right? Tell me more about that. And organically over time, it starts to build your sphere, right? And I think that's what helps drive business fundamentally.
So I know we covered a lot here between creative financing, a little personal branding in here, jam-packed. But what is one action item that you would suggest people do, whether it's creative financing or personal brand? Like what comes to your mind for all these people out there that want to be where you're at in a couple of years? Like where should they start with creative financing or their own personal brand? Like what tip would you give them?
Yeah, that's a really good question. I love the creative financing stuff, but I'll probably say that the most impactful thing you can do in your business right now, unless you have a deal that you can go and creatively finance in some way, but if you're going to wake up tomorrow and apply something, it's get active on LinkedIn, Instagram, Facebook, whatever any of these platforms are that you spend time on, and start telling people what you're doing, especially if you want to start partnering with folks on deals or raising money. That's step one in raising money, is you need to build awareness around your business. And if you don't do that, raising money is going to be incredibly challenging, right? So I think that is a very actionable thing, and it doesn't have to be perfect. Like I said, it's just throwing up a picture of what you're doing, just, talking about a recent deal that you did, or just taking a picture when you're touring a property and saying, hey, touring something today. I think that's going to move the needle, as significantly, if not more significantly, than any of the creative financing stuff you can do, because that's all deal dependent. You got to have a great deal to put that to work. But if you really get mindful about the personal branding and all of that, that's going to pay. There's an infinite ROI on that stuff.
I totally agree. So viewers out there, if you guys want to see personal brand action, go check out Axel on his Instagram. That's your main one, Instagram, right?
Yep, yeah. At Multifamily Wealth, that's the big one.
Yeah, go check out Multifamily Wealth on Instagram, see what he's doing, and you don't need to buy an expensive course for it. It's not rocket science. Copy what successful people are doing, apply it to your business. So guys, make sure you like, make sure you subscribe, and please, please, please leave some comments. We love chit-chatting with you guys. Gentlemen, thanks a lot.
Dude, you killed it.
Thanks, guys.
Great
Appreciate
work,
it.
man. That was awesome.
Thanks for having me.
Great episode.
You're listening to the Multifamily Mentor Show.
Join the conversation.